When I look at the markets, and this is just shortly after we opened, we saw, there isn't just green on the screen. Yeah, you see green all behind me. All right, these are popular stocks that you see behind me. But I want you to take a look at, what turned red. Okay, so what ended up happening this morning? Let's look at the headlines. The headlines all basically said this. All right, so first, the Asia markets tumbled. All right, this is early in the morning as Middle East conflict spirals with no sign of abating. Then all of a sudden, Trump makes a few comments, basically saying that the war is de-escalating, and he's announcing a 5-day hold on any strikes. When just a day or two ago, he talked about taking out their energy grids, taking out off the electricity grid. And so, coming into last night and coming into the day, two completely different versions from what's coming out of the White House. Obviously, what he said this morning, 10-year Treasury drops, European stocks stage a rebound, then the market jumps 900 points in the open after U.S. and Iran have held productive talks. Right, continued live updates are going on. Gold and silver pair their losses as Trump postpones the strikes. Dollar gains. All right, this is an interesting one. The U.S. dollar has been moving kind of lock and step with the stock market, which usually isn't the case. Usually a dollar goes up. That means we get strength in the dollar against what? Against assets. Not recently. And then, of course, oil tumbles after Trump puts hold on U.S. strikes against Iran energy infrastructure for 5 days. All right, let's back up a second here and let's take a look at again what I saw coming in. All right, this has been all over the board, folks. I mean, just 15 minutes before we went live, Dow was up over 1,000 points. I look now, it's up 700. But in any event, we're up nearly 2 percentage points here on the day. All right, S&P 500, again, it's having nearly a 2 percentage point upside. The NASDAQ was above 2% before we went live. The Russell was close to 3%. Then you look at the next grouping, oil, Brent oil, nat gas, RBOB, all down. And I mean down quite a bit. This was eventually going to happen. Okay. Eventually we were going to see a squeeze, a short squeeze on the stock market and a long squeeze on commodities like oil. All right. So we say oil down nearly 10%, both between Brent and regular crude. And then you've got nat gas down almost 5%. RBOB, that's blended gasoline that you and I get at the pumps, down over 8.5%. Gold, was down considerably more. It's come back a bit. Gold and silver really paired their losses. You've got copper up a little bit, and platinum down too. But then look at the bottom, that entire bottom piece you see here, cryptocurrency. Cryptocurrency is up about 5%, right, coming into the lunch hour. That's what we're seeing. And again, it's all because of this knee-jerk reaction news that we're getting. The problem with knee-jerk reaction news, and you should all know this by now, is that unless for some reason you've got some sort of feed, you got some sort of inside track to what's going to be said coming out of the White House, right? Or maybe you've been playing the other side of the coin. Obviously, hindsight 2020 said get long on Friday. All right. But that was hindsight 2020. And most people weren't listening to hindsight. Most people were coming into the weekend saying, oh boy, this, we just broke some technical lows. So the market's going to head lower. And it really looked like it was going to do that. But then this knee-jerk reaction pulled some shorts. It pulled some shorts. Some people went short on Friday. They went long this morning and they took their losses. They took some huge losses. So, when you look at this, I say this, patterns, what we do here is patterns. We don't do day-to-day patterns. For those of you that just stumbled upon us, welcome. Glad to have you here. We're not day traders. We're not meme traders, right? I don't trade the most popular thing being talked about on social media. In fact, I think the last time I looked at Facebook was in 2017. I'm running a good 9 years since I posted anything. I haven't had a LinkedIn account. I haven't had my X account is gone. Right. So yeah, I mean, I'm not looking at social media to determine what my next buy is going to be. You should not either. So what do I look at? All right. Well, I look at repeatable things that repeat themselves. All right. Patterns that repeat themselves. And the patterns we like to look for are give or take about 30 days in the market. But I've been leaning to the 30 to 90-day pattern. Tom, why are you going out 90 days? Because when volatility climbs, you got to give yourself more time. Okay. Here's a brand new rhyme I'm going to give you that I just thought of. When volatility is on the climb, add more time. Okay. Because when volatility rises, the markets do a lot of this. And all of a sudden, a lot of things like trend go out the door. Okay. But when you're using seasonality gives us the start date. Seasonality gives us the end date. And all I got to do is just push for the end dates to be longer. And that's what I want to do. Coming into the day, and this is no strength. You cannot be a stranger to this. I've been talking about this for 2 weeks now, at least 2 weeks, that the end of the month was going to be good news for tech stocks. I said tech stocks were overdone, and that if we were going to see a rally, I believed it was going to start with tech. And so did today become the turnaround day, or are we going to go through, or is this just a setup? Is this just a bull trap? Time is going to tell. But what we're seeing more and more is we're seeing as we get into the end of March, as we get into April, we're going to see more and more green on the screen. And some of that has to do with what happened last year. Okay. Remember what happened last year? The markets fell hard in March and they bottomed somewhere between, depending on when you look at it, between April 4th and April 7th or 8th. And then we started the long climb up that got us to new all-time highs last year. So are we going to repeat that pattern? Again, time will tell, but it's becoming more and more probable that we've been severely oversold, that again, seasonal patterns may come late, but we're starting to see this buildup of more and more bullish information, not just in single stocks, but in the overall markets. Let me share something with you. Take a look at this. So I blurred out, I get a bead on all stocks, start days, end days, which ones have really just the best looking setups. And the 3 ETFs that I want to share with you this morning. Okay. Now, are they the best? I didn't rank them by which ones were the absolute best, but I ranked them by more popularity. And these are having patterns. They've got patterns going on in them right now. Let's talk about each. First of all, I got QQQs up there at the top. So the Qs coming into today, they have about a 55-day pattern. In fact, all of these, the Qs, the spiders, and XLK have about have 55-day patterns. We'll talk about the differences between these 3 in just a moment. All of these going out to the beginning of June over the last 10 years have averaged anywhere from the low 6s to the high 7s in percentage moves over those next 55 trading days. That's fantastic. I mean, we're talking about the Qs 7.3%, SPY 6.3%, XLK 7.9%. Okay, in just between now and the beginning of June. So here's your spring breakout. Here's the spring breakout. It starts, I like to start looking at that 40,000 foot view. And the 40,000 foot view for me are the overall markets, the stock market, the bond market, All right. What else? Commodities, cryptocurrencies. But when I look at the stock market, I'm looking at SPY. I'm looking at DIA. I'm looking at QQQ. In this case, QQQ and SPY were near the top of the ETFs. All right. So let's take a look at each. Let's talk about differences. Well, for those of you that don't know the differences, the QQQ is one of the most popular ETFs, exchange traded funds. It tracks the NASDAQ 100, right? These are non-financial companies. If you want to know what makes the Qs, think about non-financial companies. That's what separates the Qs from the SPY. The SPY has financial companies in it. All right, it's more of blue chips, of broad blue chips. That's the S&P 500 ETF. And XLK, well, XLK is a technology select fund ETF. And so that has a focus. It's a technology sector with a focus on large U.S. tech companies. So that's the differences between the Qs, the spiders, and XLK. Let's take a look at each. Here's the Qs. So the Qs have had a lot of sideways action that really started late last year. We ran up and hit all-time highs back at the beginning of November. Let me put my mouse on it. Then again, at the end of January, we hit these all-time highs up here just prior to 640. We've also hit some multi-month lows. Now, there were multi-month lows back in October that were around this area 580, but we hit the 580 area back in December, and we did it again on Friday. And Friday, we closed near these lows, right? So green candle means we closed higher than we opened. Red candle means we closed lower than we opened. But look what happened between Friday afternoon and Monday. We had the gap and jumped right back up above the opening high on Friday. That's considered bullish. But the reason I have all this green on the screen right now is because seasonally, remember, between now and June 9th, we've got a seasonal push for QQQ. Now, let's do a little bit of work here, okay? If I believe that the Qs are going to move, let's just say 7%. Let's just say the Qs are going to go up 7% between now and June 9th. What I'm going to do is I'm going to take my $1,200 calculator here, and I'm going to plug in 590. You know, that's just a recent price of where we are right now. I'm just ballparking it. 590, heck, let's call it 600 because it's maybe where it's at now. 600 times 0.07. In fact, if you do 600 times 1.07, that gives you the target. 642 is what my $1,200 calculator tells me. Okay, so that's somewhere right above, guess where? Above the all-time highs. If we get up to these all-time highs and we push through that, there's going to be a short squeeze. There are technical traders that have stops placed right above these all-time highs. All right, so if we drift up this way, we could take those out. All right, so that's one way of doing this. Let's look at the SPY. So if I look at the SPY, I see the SPY and wow, I mean, it was rough. You have these multi-month lows down here near 650, and then we close way below 650 on Friday, and all of a sudden, boom, we're hitting 660. You got all-time highs up here close to 700. Again, take the $1,200 calculator. Can you believe? And I'm talking to Gen X here right now. Who in their right mind would have thought, I'm going to buy a $1,200 calculator when I get older? Nobody. But we did. 660 times 660 times 1.06. All right, somewhere around 6 something. That puts us at 699 or 700. That would be all-time highs. Okay, between now and June 9th. Again, The calendar is what we're using. We're using 10 years of data. Back 10 years we went to find this information, to know that 9 of the last 10 years, the S&P, along with the QQQ, has gone up between now and the beginning of June. It's happened 9 of the last 10 years. Now, I'm not guaranteeing it's going to happen again. I come to the table here with no guarantees. But again, I'm a pattern trader. When I see something happening over and over and over again, that's the side I'm going to lean on. Okay? That's the Qs. How about XLK? XLK was that was the near 8% move that we were looking for. Now, I added something else on here that I should have added on the other two for you option traders. You see that red line down here? That's implied volatility. Do you see the lows in implied volatility? And then where it is right now, the highs, right? That's true for the Qs. That's true for the SPY, and it's true for XLK. Options premium is high. That might tell you something if you're an option trader. It might give you a clue of what to do if you want to go bullish on any of these haystacks, okay? We talk about this a lot. My partner Jay talks about this a lot. He says, why trade the needle when you can trade the haystack? I like the haystack because the haystack is comprised of a lot of needles all in one. And that's what the SPY is. That's what the Qs are. That's what XLK is. It is a group of stocks that fight amongst themselves, but the overall crowd in those stocks will move it in one direction or another. It has diversification. But even diversification can have expensive options from time to time. So if you're an option trader, keep that in mind. All right. So moving forward, we know that all of these have seasonal patterns with them. They all have that 9 out of 10. Again, if I were to take a look at XLK, what am I going to do? You know what I'm going to do? I'm going to use the $1,200 calculator again. And I'm going to say to myself, all right, 140, roughly current price, times 1.08 equals 151, which guess what? Isn't even the all-time high. It's just below that. So what does seasonality do for me? It allows me to have a target time. It allows me to have a target price, okay? It allows me to have all these things. So when I go to look at target time and target price, I know when I can get in. I know roughly when the pattern is going to end. And if I'm an option trader, I have the ability to look at implied volatility to tell me, do I buy cheap options or do I have to spread by risk? So in the end, to summarize this, we talked about that big upside coming for the last couple of weeks. It looks like it may be starting. Trading the haystack is the best way to ease into a seasonal change in the markets. And that's what we're looking for, folks, that seasonal change. And then finally, implied volatility. Well, it's high right now, which could help determine the right option strategy.